Hello, this is Jessica Dunn, and this is Economic Development Finance. This chapter covers Chapter 9 in your Seedment text. First off, let's talk about debt capital and where debt comes from. First off, there are savings and loans. Savings and loans, these specialize in home loans. Commercial banks. Commercial banks are required to maintain greater liquidity than other banks. This is because there could possibly be bank runs. They need to have cash available when the consumer demands it. So if you go in there and you have a deposit account with them, you need to be able to access that cash whenever you go in. They provide short term loans, commercial mortgages, construction loans, home mortgages, mutual savings banks. These are state chartered institutions. They hold roughly 10% of all mortgages, and they're similar to savings and loans. Mortgage companies, they have very little long term debt, and they typically service secondary lenders. Life insurance companies, these companies lend money with focuses on multifamily housing and commercial properties, and they usually focus on larger loans. Pension funds. Pension funds usually invest less than 5% of their holdings in real estate. Credit unions, these are a financial cooperative. They provide services and loans to individuals with a common affiliation, and they're democratically controlled. So you have access to a credit union if you share an affiliation um, with other members of your community. So, for example, there's a Murray State Credit Union, and that Murray State Credit Union is available to all students of Murray State, all faculty members of Murray State. So we do have a common affiliation. Local development companies, these are corporations that are established with the purpose of lending capital in a specific region, and they lend in conjunction with the SBA 504 program. So they're lending with the Small Business Administration. These can be for profit or not for profit, and the Small Business Administration must approve the local development company. So, what is the Community Reinvestment Act? Here I have a link to a video by the Federal Reserve.
The Community Reinvestment Act, or CRA, is an important law that encourages banks to make loans and investments in low and moderate income communities across the country. Every year, the CRA helps bring over $100 billion in capital to these communities. Today, we're going to talk about how the CRA came to be and what it looks like in action. I'll start with a little history. During the 1970s, many communities throughout the country experienced urban decay and disinvestment. In response to this, Congress passed a series of laws designed to eliminate discrimination by financial institutions. Some laws were enacted to deal with discrimination by race, ethnicity, and gender. The Community Reinvestment Act, on the other hand, addressed redlining, a practice that was prevalent at the time where banks would deny credit to individuals based on where they lived. Enacted in 1977, CRA encourages financial institutions to help meet the credit needs of their communities, including the low and moderate income neighborhoods they serve, consistent with safe and sound operations. CRA was designed to be broad, flexible, and responsive to changes within communities. The law directs bank regulatory agencies to evaluate the extent to which each bank helps to meet the credit needs of its community. To do this, the agencies developed regulations that set performance criteria for banks of different sizes and business models. The lending, investment, and service tests for large banks are the analytical basis for all other evaluation methods. So let's discuss the performance criteria in those three tests first. The lending test evaluates the amount of home mortgage, small business, and small farm loans the bank has made in its community, or, as the regulation defines it, the bank's assessment area. It also evaluates the income level of the area where those loans were made and to whom they were made. The lending test also evaluates a bank's community development loans and the extent to which it used flexible or innovative lending practices to help meet the needs of its assessment area. The investment test evaluates the dollar amount of a bank's investments that have a community development purpose. It also gauges the complexity of those investments, how innovative they are, the responsiveness to credit and community development needs, and the extent to which those investments are or are not provided by private investors. Finally, the service test evaluates both the retail and community development services provided by banks to people and in areas of different income levels. For example, the service test evaluates the distribution of a bank's branches among census tracts at different incomes, its record of opening and closing branches in those areas, the availability and effectiveness of alternative systems for delivering retail banking services, and the range of services provided. Taken together, these three large bank performance tests provide the analytical foundation for all other examination methods. Although the exam method will vary depending on the size of the bank, no matter which examination method is used, the CRA directs one of three regulators to assign a rating to every bank's performance. These are the same agencies that write the regulations and provide guidance on how the CRA rules apply. The ratings are taken into account when a bank applies to merge with or acquire another institution or to open new branches. The agencies are also required to make the written CRA performance evaluations public. This transparency supports the participation of community organizations, local governments, and other interested parties in identifying credit needs and opportunities that banks can help meet. So now that we've talked about the CRA generally, let's see how it works in practice. Well, this is Sarah. She's a CRA officer for California Allegiance Bank, a $1.6 billion state-chartered institution based in Southern California that's regulated by the Federal Reserve. Over the past 2 years, Sarah and her team have been working to ensure that her institution's loans, investments, and services are meeting the needs of the bank's entire community. To do this, Sarah not only analyzes demographic information about the community, but she also attends meetings with local nonprofits, the Chamber of Commerce, and other stakeholders to find out what her bank can do to help meet the credit needs of the community. Sarah has also been documenting the numerous loans, investments, and services the bank has provided over the past 2 years since her last examination to show how her bank has helped borrowers buy a home, build their credit, or open a small business. Thanks to all this preparation, Sarah feels ready for her bank to be examined. This is Paul. He's a bank examiner with the Federal Reserve, and he'll be conducting the CRA exam on California Allegiance Bank. Based on the bank's asset size, he'll be using the large institution examination method. In preparation for the exam, Paul researches the demographics, economic conditions, credit needs, and community development needs of the bank's assessment area. He reviews economic changes in the assessment area since the institution's last examination, including the unemployment rate, industry growth, and the condition of local housing and rental markets. Paul also looks at credit and community development needs, including affordable housing and the local poverty rate. To complement this quantitative assessment, Paul contacts community stakeholders and asks them to describe the on-the-ground conditions they see on a daily basis. Over the course of about 2 weeks, he works with Sarah to determine which of California Allegiance's loans, investments, and services qualify for CRA consideration by identifying those activities that benefited predominantly low and moderate income areas or distressed or underserved communities. He also reviews any comments or complaints submitted by the community regarding California Allegiance Bank's perceived CRA performance. Once his evaluation is complete, he meets with Sarah to discuss his findings and preliminary rating. Paul also talks with Sarah about community needs and, if necessary, California Allegiance Bank's plan for improving performance going forward. After the exam is complete, Paul writes up his evaluation of California Allegiance Bank. The written evaluation gives details on the performance context and the loans, investments, and services that support the ratings he assigned. This evaluation is made available to the public after completion. Nonprofits and other community stakeholders working in California Allegiance Bank's assessment areas can then download this performance evaluation in order to identify potential opportunities to partner with the institution on projects going forward. Whether you're a banker, a nonprofit, or a community member, the CRA can play an important role in ensuring fair access to credit and other financial services. After watching this video, we hope you've developed a better understanding of the Community Reinvestment Act. To learn more, we encourage you to check out fedcommunities.org. If you have any questions or comments, feel free to reach out to us. We're always listening.
The CRA is not the only way that banks are examined. The typical rating scheme is called CAMELS. CAMELS stands for Capital Adequacy, Asset Quality, Asset Quality, Management, Liquidity, and Sensitivity to Market Risk. This is a proprietary measure, so I can't tell you exactly how they're measured. There are some research studies out there that have tried to do some guesswork to determine how it is measured. Uh, but again, it is proprietary, so no one knows exactly how the CAMELS rating is decided upon. CRA reviews are public. Also, you don't know what your bank's CAMELS rating is. That's not something that is going to be public knowledge because let's say that you did have your deposit accounts at a poorly rated bank. So they have a bad CAMELS rating, which means that they're probably going to fail. The first thing you would do would go and retrieve your funds from them. And so that would cause a bank run. So they're not going to ever let that information out. Um, so the CRA, the Community Reinvestment Act, basically says that banks have to serve their entire community and they have to meet the local credit needs, especially those credit needs in low income neighborhoods. So, how is community development defined? Community development, the primary purpose would be to target low or medium income individuals or neighborhoods. And an example of this would be providing assistance in securing affordable housing, financing businesses or farms that gross $1 million or less, or revitalizing and stabilizing distressed communities. So, if the CRA is working, it will help fill capital market gaps. It will help improve capital availability to small businesses. So, it's very important to economic development. But CRA requirements are not placed on non banking institutions. Banks can even own insurance and investment subsidiaries, and these subsidiaries would not be judged by the CRA requirements. So, not every single financial institution must follow these CRA guidelines. This gives banks flexibility to make higher risk loans. So, it allows banks to undertake lending, development, and investment projects that fall outside typical lending practices. So, why was the CRA enacted? It was enacted in 1977 in response to redlining. Redlining is when credit is withdrawn and banking services are withdrawn from entire areas or to entire classes of people. This requires banks to provide credit to their entire service area. Banks are allowed to define their own service area. And these service areas cannot be defined in a way that excludes low and moderate income areas. Regulators are required to judge banks' compliance with the CRA. If the CRA guidelines are not met, there are punitive effects, and the punitive effects mean that the bank may not be allowed to expand in the future. So if you have a poor CRA rating, it may not be approved for you to merge with another bank or for you to open a second branch somewhere else. You have to have a good CRA rating to be able to expand. That's really the only punitive effect of a poor CRA rating is your inability to grow and inability to expand. And so here are the lending tests. These are the measurements used for large banks. So as the video said, there are three components. There's a lending test, a service test, and an investment test. The lending test assesses bank lending in mortgages, small businesses, farms, and community development. It's looking at not only the number and amount of loans, it's also looking to the complexity and the innovation of the loans. So it's looking at a large amount of information. You're looking at this percentage amount of loans made in these made in areas. It's looking at the dollar amount, the quantity, and the complexity and innovation. The service test, this examines retail banking services. So how many branches are available? Do you have all of your branches in the nice part of town and no access in the poorer areas, or do you have branches available in your entire service area? And do you have all services available in each service in each of your areas as well? So some banks have a particular branch that may hold all components of their bank. So the lending officers may be there, they have tellers there, they also have insurance salesmen there. All of their focus would be at one branch. Um, the CRA is saying that you need to have these services available to everyone. So you need to make sure that that one branch is centrally located, or you need to have it available at different branches. So that way you may have one in the poorer area and one in the richer area. And then finally, the investment test. This looks at grants, donations, and innovative financing for community development purposes. So who does the testing? There are 3 testers. The FDIC, if banks are state chartered and they are not members of the Federal Reserve System, then the FDIC tests them. The Federal Reserve, this is the testers for banks with a state charter that are members of the Federal Reserve System. OTS, this is savings banks and thrift institutions. And the OCC, this is banks with charters from the federal government. So again, if they do fail, then their expansion applications may be denied. Community groups are the most effective enforcers of the CRA, because remember, whenever they're going through and evaluating banks, they do reach out to the community to see what they're saying about the bank. So the Financial Institution Reform, Recovery, and Enforcement Act of 1989 made CRA evaluations public. And here's a link. Okay, so here you can look up CRA ratings for a particular bank or for banks within a specific state or specific size banks. So there's lots of different avenues here. So here let's just choose Kentucky. We'll look at all banks within the state of Kentucky. Let's even define it down to Murray. Well, okay, let's just do it as a good CRA rating in the state of Kentucky. Okay, so here are the banks that have been evaluated by the Federal Reserve within the state of Kentucky that have an outstanding rating. And so you can click on these and they will show you their evaluations. So here we go. And it provides a thorough analysis of the bank. So this is looking at the Casey County Bank, located in Liberty, Kentucky. And so it's going to give an examination of not only the bank, but the community that the bank services. So you can scroll through this. It gives a description of the institution. So it's going to talk about what size the bank is and how their loans are appropriated. And so here's how their loans are appropriated. Um, the majority of this bank's loans are in single family home mortgages, 33.9%, and 19.7% is in commercial real estate. So they're really making very few farm loans. C&I loans are pretty small. Construction loans are pretty small. Multifamily loans are multifamily housing loans are pretty small. And then it's going to just give a description of the assessment area. So this is a non-metropolitan statistical area, so non-MSA. It's in the center of the state, and it is comprised of Casey and Lincoln County. The assessment area is rural. It contains 9 distressed middle-income census tracts. And so it's going to break that down into a table as well. So it has low, moderate, middle, and upper income level breakdowns, and then it's telling you how many people there are within each of the demographics. So the median family income is $39,950, and it now compares their assessment area to the rest of Kentucky. Again, non-MSA. The median home value is $79,000. And then it's going to talk about the unemployment level. So it's giving a thorough discussion of the community, of the service area for Casey County Bank. It's looking at the loan distributions. And so it's going to go through all of the different ways they can break this down to compare Casey County Bank versus other banks, and then their service area versus the rest of the state of Kentucky, to see, are they doing as well as, or are they doing better than other banks? Are they meeting all of the goals? Are they meeting all of the needs of their service area? They've had no complaints. And so this bank had an outstanding credit rating. Now you can also search for a poor credit rating. Scroll back up here. Let's see, substantial non-compliance. Not any in the state of Kentucky. Let's do all. So there aren't just a ton, but let's see. Here looks like a more recent one. This is Pacific Mercantile Bank in Costa Mesa, California. They received a substantial non-compliance.